Well, the rapid run-up in interest rates has created all sorts of complications in Canada's housing market, with a growing number of Canadians seeking to stretch amortization periods for mortgages. In theory, the idea is they want to be able to control their monthly costs, which have certainly been climbing. But now Canada's banking regulator is raising concerns about longer amortizations. Bloomberg finance reporter Christine Dobby has been covering that story. She joins us here in studio along with market strategist Philip Petursson. Christine, thanks very much for being with us. So Peter Rutledge, one of the key banking regulators, sharing some opinions this week. What exactly was his message?
So his message was that OSFI is definitely looking at this issue. You know, there's been a lot of reports about this in the media, and it's an issue that they've been following with the banks. And to kind of set the stage for what types of mortgages that this specifically affects, so stay with me here. It's variable rate mortgages with fixed monthly payments. And so as interest rates have risen in the past year and a half, the amount of that monthly payment that goes towards interest has risen and risen and risen. And so in a lot of cases, people are only paying interest. And so what we're seeing is amortization rates actually get extended. So the length of time that it would take people to pay this back theoretically has been extended, in some cases quite dramatically. And so Peter Rutledge said yesterday, you know, this is a concern for OSFI because that's really just sort of a theoretical extension of the amortization period. When people go to renew their mortgages, that is not a contractual term that has changed. So they're going to be in for quite a shock, and they're going to face way higher monthly payments. Yeah. And this is, you know, he said it's not a really significant concern in terms of the financial system. Those mortgages represent about $250 billion out of $2.1 trillion. But it's definitely something that OSFI has been looking at and trying to work with the banks to manage. Yeah, and Philip, every bank has a different policy, but in theory, I would think right now all banks want to work with their borrowers because people say, hey, what happened here? And you know, the banks have lent out a lot of money there as well. How do you think about this issue? It's a complicated one, and it ultimately has some big questions about where Canada's economy lands through all this.
Yeah, from the economic perspective, it's a burden on the consumer, and it's something that the Bank of Canada now has to pay attention to as well, because they've created this problem. As they've been raising interest rates, they've been raising the cost of mortgages over the last year. We're seeing mortgage interest costs up 30% on a year-over-year basis, and anyone renewing a 5-year term today is paying 30% more in interest costs. And that money has to come from somewhere. It's coming out of consumption to their mortgage, and it's resulting in what we think is a stagflationary environment for Canada overall. So that's the Bank of Canada's concern. Then you have the banks concern themselves.
Yeah, I mean, what's so interesting, we talk about what happens to Canada's economy versus the U.S. economy, but Christine, the duration of mortgages is a really important part of that equation because most Canadians are in these shorter length mortgages and many Americans are in, 30-year mortgages, right? And some have an interest rate and they can set it and forget it in theory. And actually some people say that's why you might see a soft landing in the U.S. Now, over the next couple of years, people will be renewing or getting into mortgages, so it could be back and forth a little bit here. You did get some perspective recently from the head of one Canadian bank on how they're thinking about this.
Yeah, I had the chance to speak with the CEO of National Bank last week, and this is an issue that's going to hit his borrowers for sure. So when it comes to fixed rate mortgages at National Bank, he said that 85% of their fixed rate mortgage holders who haven't yet been hit by the higher rates, right, they're going to be renewing in 2024, 25, and 26. And so I think there's been a lot of hope that rates would start to come down, or at least come down in 2024. But now we're hearing that inflation has been sticky, and there's not a lot of hope that rates are going to come down, or at least come down in any dramatic fashion next year. So by the time people go to renew those mortgages, they're in for a new reality, he called it.
So what do you make of that, Philip?
We've done the math on it, and if interest rates stay where they are into 2025, then the difference in the renewal rate, the mortgage interest cost, can be 150%. So, yeah, it's going to be a shock. Yeah. And we're not talking a couple $100s. It could be a couple $1,000s on your monthly mortgage payment. Now, the banks, being fully aware of this, want to be in the mortgage lending business, not the real estate business. So what they don't want is to see people default on their mortgage and they have to foreclose on their mortgage and they're left with all these properties that they have to sell. That's not what they want. They want to be able to keep people in the homes, making the payments and easing the burden on them in one way or another. But we're headed towards an oncoming train here, which is interest rates. If they don't fall soon, then the Canadian consumer, as these mortgages renew, are going to be coming under increasing pressure.
Right. And just a final word to you, Christine. I mean, it sounds like Peter Rutledge is monitoring this. To Philip's point, forced selling is going to create even more complications if people just have to get out of housing because it's so complicated. But the idea of not being able to basically pay down your loan because of this stretched amortization doesn't really do Canadians much good in the long term either.
Yeah, and I think he's said that he's been speaking with senior bank leaders about this and looking to see if there's ways that they can shrink this portion of their mortgage portfolio. I know that banks obviously are talking to customers about, raising their monthly payments now or making lump sum contributions, anything to kind of ease the pain that they might face down the road.
All right.